Good evening to you all of you students. We are really sorry for the technical issue because of which we got delayed. So yeah, good evening everyone. So we'll start today with our today's topic on dividend decisions. So while we talk about dividend decisions, the way our curriculum or the way we think there are three types of decision making that broadly we have to do. One is financing decisions. So financing decisions are those where we have to decide about how to finance any particular investment, be it equity, be it debt, or what is the right mixture between equity and debt, or if anything other than equity and debt, then what would be that right instrument. Then second kind of decisions that I think all of us have studied till now is investment decisions, which generally includes all the capital budgeting decisions, whether to invest in a particular proposal or not. Those are actually governed by the investment decisions. And third type of decisions is dividend decisions. So students, if we see, financing decision will tell us from where the sources of funds will be. Investment decisions will tell us where should I invest. Dividend decisions will tell us that with whatever operating activity we did and whatever surplus we generated, what is the right decision, whether to give dividend or whether to reinvest back into the business, what to do with that money. Vis-a-vis, what is the expectation of shareholder? So this entire topic or entire discussion of today would revolve around the dividend decisions. Yes, Dhyanesh. So while we talk about dividend decisions, we will cover through a lot of theories. We will cover through a lot of models that have been given by different people, which have evolved over a period of time. So we have to think through, we have to understand what does the model says, or what is the logic behind that thinking, so that we can also understand it better. So all of us know that whatever are the profits, or let's say surplus available with a company, profits of company. Let's say we have a company which runs for 1 year, and after that 1 year, there is some amount of profit that company earns. So company is left with two options, right? Whether to retain in the business. If we are going to retain in the business, definitely it is going to be applied for new investments that we are going to do in future, right? Or let's say if something we want to expand, not new investment, but something of expansion for the current capacity, let's say, it can go into that. So there are different avenues available, but the option is not to give it to the shareholders, right? And the second option is dividend. It can also be utilized to pay dividend, in which case the shareholder will realize some kind of return onto his investment, correct? Now students, if you see, there are different kinds, or let's say there are different forms the dividend can be paid. Right? One is very straightforward that we also know, we have also witnessed in our previous sessions, is that the cash dividend. By cash here, I mean not the literal meaning of cash, but it can be in the form of bank transfer, it can be in the form of warrant, it can be in the form of ECS check, whatever it is, but which involves actual cash outflow. What I mean is actual cash outflow. The second form by which the dividend can be given is bonus shares. Now, all of you might think that how come bonus shares be regarded as dividend? So for that, first of all, we need to understand what impact does bonus shares have on the company's balance sheet, correct? Then only we can come to know what is the impact of bonus shares in the hands of a shareholder. And let me tell you, bonus shares these days practically are used by a lot of companies to prevent immediate selling of their shares because there is a tax angle to it. I'm not covering that part, but I'm saying this is a very powerful and useful and practical concept that all of you should know. So bonus shares, some of you might know it already, that if let's say what company says is, if any shareholder is holding 10 shares, they will get one bonus share as free of cost. What will happen essentially, assume let's say that company only have 10 shares with one shareholder. Assume, although it's not practically possible, but I'm saying, let's say only one shareholder with 10 shares. And the value of that company is, let's say, 10 lakh rupees in totality. So that means per share value is 1 lakh rupees. If we divided it by 10, so we will get per share value of 1 lakh rupees. So what implication of this 10:1 will happen is, because in bonus share, there is no outflow or inflow of funds. Ultimately, this 10 lakh worth of value of the company will now be splitted into 11 after the bonus shares. So this is after bonus issue. So the per share value will be, in particular case, 10 lakhs divided by 11. It will become 9909 per share. Correct? If you think from the shareholder perspective, earlier shareholder was holding 10 shares multiplied by 1 lakh each. Now shareholder is holding 11 shares multiplied by 90,909 per each. Essentially, the value remains same. The wealth from the shareholder point of view remains same. The wealth of shareholder, the value of the firm remains same. There is no impact of bonus share. But the benefit, now the question will come that why a company will issue a bonus share. If the value is remaining same, only 10 is becoming 11, then what is the benefit of bonus share? Can anyone attempt this question and please answer on the query handle? What would be the reason why bonus shares are issued? And I can even tell you, very recently, Nykaa has issued bonus share with a very clear objective. Okay, I'm not saying that all of you should know that objective, but according to you, what are the benefits, or let's say, what are the implications of issuing bonus shares? So Alok is saying there is no actual cash outflow. Yes. Dhyanesh is saying for reducing free reserves. Okay, because what will happen once we issue bonus shares, free reserves will be capitalized. It will be transferred to equity. Piyush is saying impact is only restricted to books of company. That's right. Yeah. So I think all of you are right. In a way, it will only impact the books of the company. It will transfer the free reserves to the equity. Now I'm getting some more responses. Supal Pramod is saying in order to maintain cash liquidity. I will come back to this point. Jyoti is saying taxation benefits. Very nice, Jyoti. I will come back to this point also. Geet is saying to prevent cash off. I think Geet, your answer came somewhat partial. Please write it full. Pranav is saying to prevent from dividend, which is again to prevent from cash outflow. Prem Kumar is saying the ownership level increases, which means the dilution increases. Sharon is saying it's free of cost, which I think there will be some transactional cost. That's all. But I'll come to these 2 points. One is to maintain cash liquidity and second one is taxation benefits. Now, students, please listen to me very carefully. Now, assume in this example, I have asked you to assume that only one shareholder, but assume for a listed company, there are thousands of shareholders, right? And assume, let's say for one share, currently the price is 2000 rupees. It's a very heavy share, right? Because 2000 rupees per share, and for a lot of, let's say, minimum 50 shares, the minimum investment required is 1 lakh rupees, correct? So what will happen? And if the shareholder has to sell this, it will again need to sell entire 50 in a lot, which is around 1 lakh worth of shares he has to sell. But what if a shareholder only needs to sell, let's say 20% of its holding, not entire holding, only 20% of its holding. But because of the trading restrictions on stock exchange, it is not able to sell. What company will think? Company will say, okay, we will reduce the per unit price of our share by issuing a bonus share, and that will increase. So earlier it was holding 50 shares. Now let's say they will issue a bonus share of 5:1. For every 5 share, 1 share I will issue. Correct? So 50 share divided by 5. So plus 10 shares will be issued, which is around 60 rupees. Correct? Now what will shareholder do? It can easily sell some part of its shareholding, right? So the liquidity is improved in particular case. Correct? The liquidity will improve in the hands of shareholders. So that is the first biggest advantage, because the number of shares increases with a lesser price. Ultimately, this 2000 will become, let's say, 1800. Correct? 2000 will become 1800. So new people can also enter at 1800, right? And the number of shares with the current holders also increases. Then second point that was mentioned is taxation benefits. So I'm not discussing the taxation benefits, but yes, there is actually taxation disadvantage to the shareholder if bonus share is issued. Because in a way, the date of acquisition of a bonus issue is on the date when bonus is declared. If you are holding some shares for more than 1 year, then ideally you are supposed to pay LTCG at the rate 10%. But on bonus shares, if you are allotted within last 1 year and you are planning to sell it, then you have to pay STCG at 15%. I'm not going into the further detail, but yes, there is a tax loss to the shareholder, and hence he will not sell it immediately. He will tend to hold it for another 1 year once the bonus shares are issued. That is exactly what was done by Nykaa. Okay. Now let me go through some other responses. To prevent from cash outflow in order to decrease market value. Yes, market value got decreased. Cash outflow is also not there. For investment, avoiding new entrants. No, new entrants will come maybe because, at this price. So it can be both, plus or minus. It can be both. CRR can only be used to issue the bonus shares. That is fine. That is from the regulatory perspective. Reduce shareholders' right. Reduce or dilute. Again, the same point. For tax evasion. No, it's not for tax evasion. Anytime we can't say there is a tax evasion here. So if the company want to expand its business by investing the funds in other, then it may choose not to pay it. But yes, perfectly right, Jaspreet. You're right. So what Jaspreet is saying, if I want to avoid the cash outflow, I will not pay dividend. I will give bonus share. Let the shareholder sell some of its shareholding. Correct. Manoj is saying splitting of share. That is also fine. Piyush, share price will decrease so that small investor. Yes, perfect. Janesh, reduce EPS. EPS will also come down. That's another implication. Splitting of share also helps in transaction. Yes, all of you are right, I think. But I think what biggest takeaway for us is bonus share is also one form of dividend. So please don't confuse that. How come bonus share be a dividend? Okay. Because of all the reasons that we cited, bonus shares are also dividends. Now let me quickly go to the next part. Now, as a finance professional, or let's say as a decision maker in any of the company, most of you would feel that, what is the right trigger point, or let's say, how can we decide how much to pay dividend or how much not to pay as dividend? For example, I'm just giving you an example or a hypothetical situation. So let's say we are earning 100 crore per annum for last 5 years of average. Correct? On an average basis, my yearly earnings is 100 crore per annum, which I can freely distribute to the to the shareholders. Now, in one particular year, there is an abnormal gain of 500 crore. There is a windfall gain, and all of us know that is only going to happen only once. There is no possibility it will happen in the next year also. Again, next year, the profitability will come back to 100 crore. So in this particular year, where you have a total distributable profit of 600 crore, what do you think would be the right strategy? Whether to pay dividend basis 600 rupees or basis 100 crore, assuming that in the next year, the steady state profitability will not be there. So these are some of the questions that, we will try to have a thought process. What things helps us evaluate these kind of situations better, correct? So what are those financial, implications that will help us understand it better? Sharon is saying repeating. Okay, I'll do the repeat part of bonus share. Jyoti is asking, as per company, bonus share cannot be issued in lieu of dividend. So Jyoti, that is more to do from the regulatory standpoint, correct? Because what Companies Act wants the companies to prevent is they should not use it as a tool, right? Now, what will happen essentially every time company will not pay dividend. Every time they will keep on issuing bonus share in lieu of dividend, right? But what we are saying is we are not telling that you should issue bonus share instead of dividend. We are not saying that. We are saying whether you pay dividend or whether you issue bonus shares, the impact is that dividend is paid. Simple. Okay. So Dhyanesh is saying 100 basis 100 crore, we might pay dividend in this particular example. So we'll see. I mean, there is no thumb rule to it, right? Some people might say that shareholders also know that there's a windfall gain of 600. Why are we not distributing it? But what if, let's say, company has better investment opportunities? That is also one of the key factors. So we will discuss all those things. First of all, for Sharon, let me repeat the bonus issues part. Okay. So Sharon, what we discussed is that dividend can be distributed in two forms. One is in the form of cash dividend and second in the form of bonus shares. Now, why we say that bonus shares is also one form of dividend is that because the entire holding amount remains same, the value remains same, the shareholders' wealth remains same, but the numbers or the units increases because of the bonus shares, correct? So earlier, let's say I was holding 10 shares. Now, after the issue of bonus share of 10:1, I will be holding 11 shares, correct? So with that, I have increased, capability, or let's say I have increased liquidity with which I can sell the shares. Earlier, let's say, for example, I was not willing to sell entire 10 shares, but I have an option now. And this specifically, you think it from the perspective of the huge number of shares that, huge number of shareholders held, correct? So this is what we discussed. So Pranav is saying dividend should be given on 100 crore basis. Okay. Parth is saying increase capitalization. So we will discuss, what are the other factors needs to be considered before we take on any decision. Now, before we move into some of the techniques or some of the models, first of all, we need to understand that what is the significance of dividend policy. So I think all of you would agree till now, basis whatever discussion we did, that deciding on dividend is not a easy thing, correct? It has a lot of, ifs and buts. It has a lot of decision-making factors. So there definitely every company would follow some kind of a dividend policy, correct? And here we are going to study what are those significance. So first of all, there are a lot of decisions that company has to take. One of them is long-term financing decision. Now, please think it from the perspective of a company which has good amount of investments already, right? But what if, let's say, there is a good further opportunity comes for investment, and that too for over a time horizon of, let's say, 15 years, 20 years, 25 years, right? So do you think that currently what are the opportunities available? Are those opportunities profitable? What is the ROI on those opportunities? If all of them are making sense and we decide to go and grab that opportunity, that investment opportunity, we would need funds. Now the decision here comes how we should do the funding for those funds. Whether we can go for another equity, or rather than going for another equity, can't we stop the dividend payout and flow it back and use it for the long-term financing decision? We can do that, right? But please take I'm just throwing one concept here, which is rate the internal return, which is ROI, is let's say 20%. So for the investment opportunity that we got, we can easily make 20% return on investment, which is ROI. However, shareholders' expectation, which is cost of equity. Please remember these two terms very importantly, cost of equity. This is return on investment, sorry. So R is return on investment. So the shareholders expect somewhere around, let's say 18%, but the project will give 20%. So do you think as good governed company, we should actually take on that opportunity and invest the dividend amount that we were supposed to pay into this project, so that we are making more money than the expectations of shareholders? Okay, we will cover this topic further in detail, but as of now, that is where the long-term financing decisions plays a significant role in the dividend policy. Then second point, which is wealth maximization principle, or let's say decision. So students, ultimately any company exists for a single most objective, which is the financial objective, the single most financial objective. There can be other business objectives, there can be other social objectives, but I'm saying the most important finance objective is the wealth maximization of its owners, which is shareholders. So every decision has to be made in such a manner that the share price increases, the entire wealth, or let's say the market capitalization increases, right? How can that be done? That can easily be done if, let's say, the company is not able to deliver better, then there is no need to keep the money in company itself. The money can go to distribute to the shareholder, and shareholder himself will decide where he wants to put that money. Correct? So that is what about wealth maximization decision. Sorry, these are the two, not third one. These are the two principles. Now assume if we pay immediate dividend here, would it lead to higher MPS? This is the question that we will try to answer. While we are studying wealth maximization, the market price per share has to increase, and resultantly the market cap has to increase given the same number of shares. So these are the two, significance. No, Geet. So Geet is saying that any other conditions as per company law, no, that you can study in the Companies Act, right? The regulatory part of it, of the dividend, that you can't use securities premium, you can't use capital reserve, your current adequate profits should be there. So all those things you will study in your Companies Act, correct? Not here. Here we will study certain core things. What is the right value of the share? If the dividend is given, if the dividend is not given, we will study all those, some of the techniques, whether to decide whether to give dividend or not. Okay. We are not going to study the regulatory aspect. So Parth is saying we might retain earnings for investment also. Yes. So we will deal with all these situations. So students, in the previous session, we studied something about estimated cash flows and expected cash flows. Why I'm touching this point will again come in today's session. Hence, I just wanted to again revise. So estimated cash flow, we said, okay, there are three possible cash flows with different probabilities, and the mean of this will become expected cash flow, correct? I'm just revising it. We will touch upon this point sometime later today, okay? In the dividend decision also. Now there is an important thing. As we said that dividend can be paid or can be retained, correct? The earnings can be paid as dividend or earnings can be retained for future growth. Now, ultimately, once the earnings are retained into the business, they will lead to some growth. How it will lead to growth? Because it will be treated as an additional investment. And on that additional investment, there will be some additional returns that the company will be able to generate. Correct. Now, assume let's say there is a factory, and that factory has a capacity of producing 10,000 tons of, let's say, steel per annum. For example, I'm just taking a hypothetical example. For 1 year, after 1 year, it operated, right? The amount of cash flow that got generated is, let's say, 100 crore. That came from the operating profits. Now, company has a choice to pay this 100 crore as dividend or to pay as, or not to pay as dividend, correct? So let's say 20 crore is paid as dividend, balance 80 crore. Since the company wants to expand the capacity, what they have done, now they have purchased any additional 2,000 tons of capacity. So after investment of 80 crore, the capacity is increased to 12,000 tons per annum. And because now the company is able to produce more and hence sell more, the profitability also got increased to 120 crore in the next year. Okay. So we can see that there is a growth. Correct? There is a growth. What is the growth? 20 crore, which is around 20%. So 20 divided by 100. What is the fuel of this growth? The fuel of this growth is this investment of 80 crore. Very simple. This is the same ideology with which all the economies work, all the companies work. They always see that additional investment should lead to some sort of additional benefit. That additional benefit is called as growth, which is also represented by G, and growth is B into R. This is our most important formula which we will be using. So here G is equal to growth, B is equal to retained earnings, correct? And R is equal to return on investment. So students, it is very simple. Growth is what? Growth is simply, see, what was growth in my example? Always think of this example. Whenever growth comes to you, we earned something. From that earning, we paid something and we retained something. So this 80 crore is retained earnings, correct? Which is B. Yes. So this is B. On that retained earnings, what is the rate of return? And hence, if we multiply that the rate of return on that earnings, we will get the growth. Correct? We will get the growth, which is 20 crore in absolute terms and 20% in percentage terms. So Let me take some of the questions. Jaspreet is saying, yes, sir, it will lead to higher MPS as if dividend increase, market price increases, and if dividend decreases, market price decreases. No, Jaspreet, I will come to that point. So I will come to that point. Whenever you pay dividend, the ex-dividend price decreases, but the wealth of shareholder never decreases. Wealth always remains same. Okay. So don't link dividend with the market price. Okay. We will study some of the theories. We will understand better. Geet, okay. B is retention ratio, right? B is retention ratio or retained earnings, whatever. See, if you're talking about in absolutes, it is retained earnings. If you're talking about growth in percentage, then this will become retention ratio. And this is already in percentage, return on investment. Okay. Because in my example, I took 20 crore, which is the absolute amount here. Hence, I told that whatever is the retained earnings, from that it can be multiplied. Okay, Geet, thank you. Dhyanesh is saying there is a direct relationship between growth and retained earnings. Yes. Higher retained earnings, higher growth, provided your rate of return on investment is also reasonable. Okay. Yes. Now let's move further. Perfect. Now we can jump to the theories. By name, they are theories, but there is a lot of practical involved. Okay. So don't go by name. Theories of dividend decisions. So theories here means what are the different kinds of models that we have to study. We can classify it into two parts. One is irrelevance theory or irrelevant model. Second is relevance theory. Or relevant model. Okay. So students, please first of all try to think what does the model says, what is the implication of this model, and then we will apply our judgment. Okay. But first don't apply your judgment because the model has been designed. All the models that we're going to study have been designed in a particular specific situation. Okay. And according to me, all of them are right. And if you compare relatively, all of them are okay, right? But all of them have some different thought process that we have to understand. So first one is approach. So this is the only irrelevant theory in our curriculum, which says this was actually given by Modigliani and Miller. This is also called as approach. So what does this approach say is whatever decision you take, whether you want to pay dividend, whether you don't want to pay dividend, it will not have an impact on your pricing, or it will not have an impact on your pricing. Definitely it will have, but it will not have any impact on your shareholder wealth, or let's say the value of the firm or value of the company. It will not have any impact. So it is irrelevant. They say whether you pay or whether you not pay, shareholders will not have any issue in their life. They will be least bothered. But this is actually applicable in a perfect capital market, right? Which is very difficult to see in today's practical world, correct? Because everywhere there is no perfect capital market these days. There are a lot of things, for example, insider information, for example, tax, right? For example, other discriminations in the markets. So, but let us understand what is the theory saying. Then in the relevance theory, we have two theories to cover. One is Walter's model. And second is Gordon's model. I actually really like all these three theories because there is something or the other to learn from all the three theories. Okay. So we will cover approach first. Okay, so Jaspreet is saying, sir, then what would be the answer to your question? Immediate dividend, would it lead to higher MPS? So again, so Jaspreet, just wait for another 1 hour. You will get your response. Okay, because I have to explain all the three theories to tell you what is the implication. Okay, because the dividend impact on MTS depends on lot of things, which all these three are going to tell us. Okay. So Jaspreet, don't worry. That is what we are supposed to learn today. Okay. What impact does dividend have on the share price? Now coming back to first theory. I want all of you to please pay your 100% attention here, because this is the most important part that we are going to discuss. So let's discuss about approach. Okay. So I'm just writing this statement here. Irrelevance theory. Whatever dividend is paid / not paid, it will not affect the value of company. Okay. Perfect. Now, let us build our concepts from here. So this theory says that whatever you pay dividend or whether you not pay dividend, value of the firm will remain same. Value of the company, I will use value of the firm or value of the company interchangeably. So it will remain same. For example, let's say this is the movement of share price. It was 30 at Y0. This is year 1 end, and it becomes 40 here. Okay. It rises. In this case, no dividend is paid. What is the shareholder's wealth? 40. Correct. One share he's holding, no dividend is paid. 40 is the wealth. Now assume second case, 30 Y0. It went to 40, but they paid a dividend of 5 rupees. After 5 rupees, the share price became 35. This is all at Y1, for example. Now, what is the shareholder having? 1 share at 35 rupees plus cash at 5 rupees. In totality, he is having 40 rupees. Correct? Because immediately after the dividend is declared, the price will fall down to 35. And 5 rupees will be in the form of cash. Ultimately, the wealth remains same. Here also it is 40. Here also it is 40. So from the shareholder perspective, there is no difference because the wealth is ultimately remaining same. Can we now see it from the perspective of company? Because this proves theory from the perspective of shareholder. I think all of you agree, right? Now let us see it from the perspective of company. Because ultimately company's value should also be remaining same, right? If we pay dividend or not, for this theory to work properly. Now, yes. So let's say firm pays dividend using, let's say, reserves and surplus. So the dividend is paid using reserves and surplus. Correct. As we said that 30 has gone to 40 and again -5 for dividend. Yes. 35 becomes the share price. Ultimately 40 is the value that is there. Okay. Just hold on to this point. I will come back to this point. This theory have an inherent assumption that whatever amount of dividend needs to be paid, the company has to borrow it. Borrow it by the issue of new equity shares. By borrowing, I mean they will issue new equity shares and basis the proceeds that the company will get, it will actually pay the dividend. This is one of the inherent assumption, right? Firm pays dividend. In cash by issuing new equity shares. So Manoj is asking in which year MM theory was given. I really don't know in which year it was given. Okay, Honey is asking me to repeat. Honey, I will again repeat the entire MM theory with very good example. Okay, but for the moment, just be with me, right? Because I know it's difficult to absorb first of all, but please be with me. I am telling you that all of it's very easy to apply actually. So just be with me. What I am trying to say, please listen to it, and it will be through. So what company will do? Company will first of all issue new equity shares. This is the first step. By issuing equity shares, it will receive some cash. Yes, this is the second step. After the cash is received, the third step is company pay dividend. It sounds strange, right? And I don't know whether companies have to also allow this or not, but think it from the perspective of financing your dividend. Equity share is one form of financing the dividend. I think that might be the objective. So what will happen to the shareholder? Share price plus dividend, correct? Yes, minus valuation loss, or I can say dilution. I will substantiate everything with example. Okay, we have good examples we will cover. But what I'm trying to say here directionally, please only understand directionally here is one, shareholder will get dividend. Second, after payment of dividend, whatever is the price, that share price will also be there for one share. Minus, there will be some valuation loss that the shareholder has to incur because new equity shares are issued and the control is lost. Or I can say the control is diluted, right? The shareholding is diluted. And the third case can be firm don't pay dividend. Firm don't pay any dividend. In that case, market price is 40. It will continue to be 40. No change in the life of shareholder and in the life of company. Already it is at 40. No, Pranav, that we can't assume that it is through other debt or debentures because otherwise it will fail one of the assumption of MM theory. Okay. Now, please all of you concentrate on this example. This will help you, everyone, to understand what is the entire saying of this theory. Okay. Example, there are 2 lakh equity shares and the price is 10 per share. Clear? No borrowings. Also, it is mentioned that all the reserves and surplus are invested in capex. So essentially, you are not left with any of the reserve and surplus in form of cash, because whenever it happens, it ultimately goes into capex, which is capital investment, right? This goes into capex. Cost of capital, we can call it KE. This is the expectations from shareholders, is around 10%. So shareholders expect that whatever amount they invest in a company, it should actually give them 10% return. Okay, students, this is the fact pattern that we have. So Dhyanesh is asking how new shareholders will agree for payment of dividend to existing shareholders from their money. Very good point. Any which ways, if you float a FPO or IPO in a market like today, no shareholder will give money to the company for paying it as a dividend. But on the other hand, Dhyanesh, please try to understand the spirit and intent of this theory. I will explain. Ultimately, what I have mentioned here, all the reserves and surplus are invested in capex. What if I am not investing? What if let's say I change this line, I say that reserves and surplus I will pay as dividend, but whatever is required in capex I will borrow. Still my reserves and surplus, or let's say not borrow, I will infuse new equity. Okay. So what I'm saying is reserves and surplus are distributed as dividend, and whatever I need to invest, I get it through equity. You're getting my point, Dhyanesh? So the total of reserves and surplus and fresh equity will be equal to the total of dividend and investment. You understand that? So that is what the intent. The intent is that ultimately there is no one-to-one correlation between your investment in equity and paying of dividend. It's just a pool of funds. You are getting new equity, you are getting reserves and surplus, you are paying dividend from that pool, and you are also investing in that pool. Okay. So that is what the intention is. Parth is asking, firm dividend need to be given from free reserve or premium. How many equity share money can be used? That is what I'm saying. Don't get that barrier that how can new shareholders' wealth be used for the payment of dividend. I'm saying think it from the point of view of common pool. Company has a common pool of funds in which the money is even coming from investment of equity, right? The contribution from equity shares. The money is also coming from our own retained earnings, which is reserve and surplus. And that money is being used for investment and dividend. That's all. That is what the perfect capital market is, right? So hence I'm saying that for this particular thing, let's assume all the reserves and surplus goes directly into investment, and whatever new investment in the form of equity comes, that is being used for the payment of dividend. Okay, for 1 minute, please assume. Then expectation from shareholders is around 10%. So what we have to do, first of all, we have to calculate the market price. Please understand these steps. Market price at the end of year 1 will be market price at the beginning of year 1, which is P0, 1 plus KE minus D1. This is the first formula to remember, and it is very easy one. So I think all of you would correlate it. So P0 is the price of the share today. 1 plus KE is the expected return that the shareholder have. So what shareholder will perceive in the market? That with this percentage, at least the share should increase by the year end, correct? And if any dividend is paid within that year or up to that point of D1, the first year, that should be reduced from the price, because that encashment already has happened from the price. In our example, can we calculate this? Yes. So we can calculate this. Yes, we can calculate. P1 is equal to 10 is the basic price, is the current price, this one. 1 plus 10% is the cost of equity, which is this 10%. The expectation from shareholder is this, right? Now we will use this to prove our hypothesis. So in first option, we are assuming that no dividend is paid. P1 is equal to 10, 1 plus 10% minus 0, correct? So that means P1 will become 11 rupees. What is the value of firm after 1 year? Value of company after 1 year. 11 is the price. 2 lakh is the number of shares. It is 22 lakhs. All of you agree? Till here? Yes, Dhyanesh, you're right. We have to assume for understanding the theory, okay? This is clear? So as I told you that we are trying to prove it from the perspective of company now, right? So the value of the company is 22 lakhs, which is fine. Second, perfect. Second is the company pays dividend at the rate 3 per share by issuing new equity shares. Perfect. Company pays a dividend of 3 per share by issuing new equity shares. In this particular case, what will happen? P1 is equal to 10, 1 plus 10% minus 3. Correct? First of all, you have to calculate the price. So the price after the payment of 3 rupees per share will become what? 8 rupees, right? Which is 11 minus 3. Now the amount of dividend is how much that we have to pay? 3 into 2 lakhs, correct? Number of shares to be issued for funding dividend. I am just writing funding dividend here. Again, I'm saying, but please don't assume that there is a one-to-one correlation. It might happen that reserves and surplus would also go in the same pool. Investment in equity would also come in the same pool. So this is 6 lakhs. 2 lakh into 3 divided by 8. Because 8 is the revised market price per share. So the 6 lakhs divided by 8 becomes 75,000. Okay, students. So 75,000 is the number of new shares that needs to be issued. Okay. So the value of company becomes how much? 8 would be the price of shares. 2 lakh are the existing shares plus 75,000 new shares are issued. So 8 into 2 lakh 75,000, which is 22 lakhs. Perfect. Again, it remains same. So this is one and this is another one. 22 lakh, 22 lakh. Whether they pay dividend or whether they don't pay dividend, it remains same. Thank you, Sapna. Ceteris paribus assumption will also apply to this theory. So we will, okay, we will see. Okay, Prachi is saying, sir, please explain again. I will do. Sufal is saying, so ultimately we are just dividing the benefit either entirely through capital appreciation or partly dividend and partly. Yes. Yes, you're right, Sufal. Somewhere what you're saying is right. I will explain, Prachi, this again, okay? So what I said is just focus on this example and just leave everything else aside. There are 2 lakhs equity shares at the rate of 10. There are no borrowings and there are no reserves and surplus also, because whatever is reserve and surplus, those are already invested. There is an expectation of the shareholder that they should at least earn 10%, which is cost of equity KE. This is nothing but the same thing that you would have calculated in CAPM, capital asset pricing model. Okay. Now, first of all, we have made this equation very clear that what is the price at the end of 1 year is this, correct? Which is today's price increased by the shareholder's expectation, which is cost of equity, minus any dividend that is already paid, correct? Now, since our entire decision making is whether we should pay dividend or not, hence we have taken these two cases. One is we are not paying dividend and one is we are paying dividend. If we are not paying dividend, then the value of the firm becomes 22 lakhs. If we are paying dividend also at 3 rupees share, this 3 rupees is just a hypothetical number. You can assume 4 rupees also, and you do calculation basis 4 rupees, you will still get 22 lakh rupees. Even if you assume 1 rupee here as dividend, you will still get 22 lakh rupees because your number of shares will change. Why will your number of shares will change? Because your price will also change if you change the dividend. Okay. Ultimately, your overall value remains intact of 22 lakh rupees. Hence, they are saying that it is an irrelevant theory. Zufa is saying, how come this rupees 3 as dividend? So 3, I'm assuming Zufa, as just now I said, it can be 3, it can be 4, it can be 5, it can be 1, it can be 2, it can be anything. So you have to do the recalculation, and if you do, you will still get 22 lakh rupees. That is my guarantee. Honey is saying D1 is next expected dividend. Yes, D1 is next expected dividend. I'm saying the 3 per share is expected dividend to be paid. So I'm saying you assume D1 is equal to 3. So, honey, I'm not complicating D1 and D0 as of now. I'm just saying that D1 is equal to 3. Okay. So we will add growth in Gordon's and Walter's model, honey. Okay. Dhyanesh is saying it means if we pay dividend or not, the value of the firm does not affect as per this theory. Yes, that's what I'm trying to say. That's what this theory is trying to say, which I'm trying to teach you. Okay. Perfect. Now, we will come to, I think this is the main formula, right? Which has to be clearly understood. We have already seen what are the pros and cons here. So what if I do P1 plus D1 is equal to, I will take D1 here. So P0, 1 plus KE. This we can do easily. Then P0 is equal to P1 plus D1 divided by 1 plus KE. That we can do, right? And this P0, if we have to take as a value of company, or let's say value of firm, this can be expressed in any form, value of company or value of firm. So then we will have to multiply with the number of shares, right, in the entire equation. And we should also take the new number of shares. So this becomes N plus delta N P1 minus I plus E divided by 1 plus KE. So this is the formula that we have to remember for calculating the value of the firm or value of the company. I will tell you what all things are mentioned. Value of company. P1. Price at year end. I. Investment required. Now that the common pool understanding that I gave you just 5 minutes back. So try to think this minus I plus E from that perspective. So whatever we have to invest, that is what I want to have, the funding. E is already available. Balance I have to fund from the new shares. Okay. E is actually earnings. So earnings is already available. Investment required is I. Delta N is the new equity shares. to be issued. N, these are the existing number of shares. KE, we all know that is cost of equity. Right? Thank you, Prachi. Janesh, done. Sharan is saying in this question they will not give the value of dividend. No, they will give. So Sharan, we will come to the questions. I mean, if you see questions would be peanuts for all of you. I can tell you. You all have that kind of understanding already. So questions are very easy. So questions will give you everything. They will also give you dividend. Okay. Perfect. Okay, so we just need to remember this formula. And I mean, not even to remember, but just try to think about the logic. So here what we are doing is n plus delta n, whatever is the new shares plus the existing shares multiplied by the price. So that will give us the value of the firm at the end. If we take a present value of that, that's why we are dividing it 1 plus KE. But there is additional element because there is a fund shortage or funds excess. Because if I do investment more and my earnings are less, I still need to fund the shortage from somewhere else, which is where the new equity shares will come. Correct. Perfect. So let's go to question number 1. I think now the assignments have been uploaded. The questions have been uploaded. You can refer question number 1 from there. What about the case where we study the dividend is distributed from R&S only? So you can assume that dividend is distributed from R&S only. In that case, investment will be 0 and E will be there. Okay. So Petla Divla had a question that how if entire earnings is given as dividend, that also this formula actually accommodates. If you see here, whatever we have written. So in that case, E will be there, I will become 0. Simple. Okay. And accordingly, you can get your answer. So let's do this question step by step. Again, this will be an attempt to, to print this concept in your mind. Simple. AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. KE is given as 10%. It currently has outstanding 10,000 shares selling at 100 each. These are number of shares. The firm is contemplating the declaration of a dividend of 5 per share. Contemplating, they have not decided yet. They are evaluating, right? 5 per share. Perfect. At the end of the current financial year, which is D1. P0 is equal to 100. N is equal to 10,000. It expects to have a net income of 1 lakh. Earnings, it is expecting to have 1 lakh and is a proposal of making new investments of 2 lakhs. It will make investments of 2 lakh for which it will need funds. But already it has 1 lakh. So balance 1 lakh only it needs to fund outside the company, which is through new equity shares. Hence, I'm telling you, again, think it from a pool of funds perspective. The requirement is 2 lakh, 1 lakh is internally available, 1 lakh we will take it from the fresh equity. Calculate the value of the firm when dividend are paid and dividend are not paid. So we will take the first one first, which is value of firm when dividend are not paid. So in such a case, P1 is equal to P0, 1 plus KE minus D1. P1 is equal to 100, 1 plus 10% minus 0. So P1 will become 110. Step 2. So this is step 1. Step 2, calculation of new equity shares to be issued. Let's first calculate the funds requirement. Funds requirement, we need to have, one is for investment is 2 lakh rupees, less earnings available is 1 lakh rupees, add dividend. In this case, it is nil, correct? Because we are solving this question that dividends are not paid. In this case, it is nil. So the net amount required is only 1 lakh rupees. Net amount is only 1 lakh. Number of shares is equal to 1 lakh divided by 110, sorry. The price was 110, right? 1 lakh divided by 110. So the number of shares comes as whatever it is, 1 lakh divided by 110. Okay, students. Next step. Step 3. Calculation of value of firm. Value of firm is equal to n plus delta n P1 minus I plus E divided by 1 plus KE. N, how many shares were there earlier? 10,000, right? 10,000 shares. The new number of shares are 1 lakh divided by 110. I'm not opening this fraction because it would get cancelled from here. Okay. Just simple formula putting here. So if you solve this, the value of the firm will come as 10 lakhs. Please remember this value comes as on today because you have already done a present valuation here. So this value of the firm comes as on today. Now the second case, when dividends are declared. In this case, P1 will be 100, 1 plus 10%. What is the value of dividend per share? Rupees 5. So P1 becomes 105. Correct? This is step 1. Within second, requirement, this is step 1. Step 2, number of shares. For that, first of all, investment required is how much? 2 lakh rupees minus earnings 1 lakh rupees plus dividends 5 rupee per share on 10,000 shares. So you need how much? 50,000 rupees. So net you need 2 lakh minus 1 lakh plus 50,000. 1 lakh 50,000 is what you need. Divided by price per share. What is the price per share? 105. So hence number of shares is equal to 1,50,000 divided by 105. Again, I'm not opening this fraction. I'm not calculating this fraction because it will lead to pointers. Yes, Prachi, Alok, Sharan, all of you are right. Thanks for answering. Now the value of firm will be 10,000 were the initial shares. 150 divided by 105 are the new number of shares into 105 minus 2 lakh plus 1 lakh whole divided by 1 plus 10%. So this will also give the value of firm as 10 lakh rupees. Again, this is as on today. Now you can compare. No dividend. Yes, dividend. Value of firm 10 lakh. 10 lakh in both the cases. The MPS is 110. Here it is 105. Simple. So answering Jaspreet's question, I think. Thanks, Sharan. I think all of you are right. Abdul, you are also right. Janesh, 10 lakhs is right. So there was question from Jaspreet. So Jaspreet, what you mentioned about the MPS after declaration of dividend. So this point is true. As per this theory, it is true. Okay. Whatever dividend you pay, your MPS will come down. But actually, if you see from Walter and Gordon's model, we will again see the same point. Okay. Because in those models, the price also depends on the future capability to earn, not only the existing one. Okay. So this is understood. So this is what the question has asked us to calculate value of the firm in both the cases. It is same. Hence, it is proved it is an irrelevant theory. It has no relevance. Okay. So let's do one thing. Let's break for 10 minutes because now next model we have to start, which is Walter's model. So it is 7:18 now. We will meet at 7:28. Thank you. So before break, students, all of us, we discussed about this theory of Modigliani and Miller. Hani is saying to show the solution, hence I'm showing it again once so that, you can just write it. This was the last part that we covered. Thank you, Sapna, and thank you, Sharan, for confirming that everything is okay. Perfect. Let's go to Walter's model now. So irrelevance theory is done, students. Now we will start with the relevance theory, which is Walter's model, which says that the payment of dividend or not payment of or non-payment of dividend will have an impact on the value of the firm or will have an impact on the shareholders' wealth. Okay. So, I mean, the concept is very easy. Correct? So the price multiplied by the return expected by the shareholder is essentially equal to dividend. Or I can say, instead of dividend, I can say earnings, right? So can I write it like this? Earnings divided by cost of equity. Simple. But what if some of the earnings is reinvested? That is the question, right? Some of the earnings is reinvested then. So I can say that whatever dividend I am paying, that they will say, okay, out of that earning, and whatever dividend I'm not paying is left with this, that this retained amount, so E minus D is earnings minus dividend, is the retained amount is getting invested R. Hence, this is the formula. So what is Walter saying? Walter says two things. That the price of the share is dependent on two things. One is how much dividend you pay now, right? Which is actually the cash that a shareholder receives. And whatever you reinvest, on that you will be able to earn R, which is rate of return on the internal, or let's say the return on investment, that shareholder will equate with KE, because shareholder would say that, okay, whatever is the cost of equity, I will assume that this is the value. And this, since this is the value of the return, if you see the numerator is return, if you divided it by the expected return, then only you will get the full price. Okay. So P is equal to price of the share. E is equal to earnings per share. D is equal to dividend per share. R is equal to return on investment internal. And KE is equal to cost of capital, which is external. Cost of capital is expected by the external shareholders. Okay. Now, using this, I'm going to explain the relationship between MPS and dividend. One of the questions from Jaspreet also, right? How will dividend get impacted? How the impact of dividend will happen on MPS? Okay, students. So Walter model is this only. That's all. There is nothing else in Walter's model. But the theory explains a lot. So this formula implies a lot, which I will discuss through this relationship between MPS and DPS. So students, everything is actually dependent on these two things. Return on investment, which is internally how much return I am able to generate. KE is equal to cost of equity. What is the expectation of shareholder? You remember in the long-term financing decision, the significance of dividend policy, I again covered these 2 points and I told you that we will cover this in detail. Now that is the point in time where we are covering it in detail. So I'm going to write some scenarios here, which are very much self-explanatory. And we will also talk about some of the relationship between dividend and MPS and what is the optimum dividend payout ratio. So it will help you to answer two things. So this relationship study that we are doing, or let's say in a way, Walter's model is helping you answer two things. One, what if you pay dividend and what is the impact on MPS? Second, how much dividend is the right amount to be paid? So it lists down three scenarios. One is the growth scenario. In growth scenario, R is greater than KE. Okay. So the internal rate of return, or let's say the return on investment that the company does an investment, they are able to generate more return compared to the expectation of the shareholder. That is called as a growth firm. If in this scenario, you declare dividend, then you have done a very big mistake, because it's better to reinvest that money and earn a higher return, because your return is already higher than the expectation of shareholder, correct? So even shareholder would want in this particular case that you keep your money with you, the company should keep the money with them, and they should expand, they should keep on investing and generating more return. So here the relationship will be negative. Higher dividend, lower MPS, because I will not value that share much, correct? Because I want the dividend to be redeployed with the company itself. I don't want any dividend in my hands as a shareholder. So the optimum dividend payout ratio is 0. Simple. Then we have a constant case where R is equal to KE. So in this case, there is no correlation at all. Whatever you want to pay, you can pay, because whatever shareholder expects, company is able to deliver. Any ratio can be optimum. It can be 50-50. It can be 60-40. It can be 40-60. Whatever you want to pay, you can pay. Declining case. In this case, R is lesser than KE, correct? The internal rate of return, or let's say the return of investment on the internal projects, is giving you lesser amount or lesser return as what is expected by the shareholders. So in that particular case, shareholders would expect that company should pay all the amounts as dividend, because company is not performing better and there are no future growth prospects. That is why it is a declining case. So higher the dividend, higher the MPS, the relation is positive. The relationship is positive. And we would recommend 100% dividend payout in such a case. Students, this table answers two questions. One is Jaspreet's question. Let me go back to the question once. Yes, one is Jaspreet's question. This Jaspreet, you can have a look here. I think it answers your question, right? In a very detailed manner. Second, it also answers the relationship between growth and retained earnings from Dhanesh. Okay. Piyush is saying growth is like compound profit. Yes, very well. Growth is definitely a compounded profit, because you will invest on that also you will get growth. Again, you will invest on that also you will get growth. Okay. I hope this is clear. Perfect. Let's move next. So students, in my previous session, we covered about two things, or not two things, but many things. But one of the thing was variance. What I said for variance is, it is a deviation. So I can put it like in this manner. Deviation of estimated cash flow with expected cash flow. Okay, this is the deviation. That is what variance was. Expected cash flow was mean. Estimated were different possibilities, right? What is covariance? So covariance is again deviation, but deviation of what and what? Deviation of, let's say, X Limited's share price. Now, instead of share price, you can assume anything else also. But there are two variables. Covariance is for two variables. Variance is for one variable. Covariance is for two variables. Okay. Any two variables. I am taking here as share price as an example. X Limited's share price. Movement. Or let's say estimated versus deviation of Y Limited's share price movement, or I can say the estimates. Okay. So this is what covariance is. So in this, mean is not involved. Both of them are calculated. So basically X Limited in possibility A, what is X Limited return, what is Y Limited return, that will be calculated for the deviation purposes. Okay. I will actually come back to it once it is used. Question number 2. Let's go to question number 2. XYZ Limited earns rupees 10 per share. Capitalization rate and return on investment are. Capitalization rate is KE. Return on investment is 12%. Okay. Determine the optimum dividend payout ratio and the price of the share at the payout. Simple. Is it a growth firm? Yes. Because R is greater than KE. So what is the optimum dividend payout ratio? 0. Correct? As per the above table that we just now studied. So we can write simply, since R is greater than KE, the optimum dividend ratio would be 0. Simple. And the price of the share at the payout will be calculated using this formula. D plus E minus D R divided by KE whole divided by KE. This is the Walters model, right? So P is equal to dividend is 0 in this particular case. As per our hypothesis, we are saying that the dividend payout ratio should be 0. Earnings is 10, that is given, minus dividend of 0 into 12% divided by 10% whole divided by 10%. Correct? Perfect. So the price comes as 120. So this is the price that comes as per the Walters model. Let's practice one more question. Question number 3. The following figures are collected from the annual report of XYZ Limited. Net profit is given as 30 lakhs. Outstanding 12% shares is given as 100 lakhs. Number of equity shares are 3 lakhs. Return on investment, which is R, is 20%. Cost of capital, that is KE, is 16%. Compute the approximate dividend payout ratio so as to keep the share price at 42. This is now another kind of example. Now, students, please note in this particular case, also the optimum dividend payout ratio is 0 because the shareholders expect 16%, companies earning 20%. Why would a shareholder want any money in the form of dividend? Shareholder will say, okay, you keep on investing the amount at 20%. My expectation is only 16%. I'm still making 4% more by keeping money with you. Okay. So, but the question has a twist here. Question is saying that, no, I don't want the highest MPS, market price per share. I want an MPS of 42. Now you tell me at 42, what should be my optimum dividend payout ratio? So simple, we have only this formula, right? The beauty of this Walter model is that there is only one formula. So anything has to happen within this formula only. Price is given now 42. Dividend is what we have to find. Earnings is how much? Earnings we can calculate, right? I'm just calculating earnings here. Calculation of earnings per share. What is the net profit? Net profit is given as 30 lakhs. Less preference dividend. Now, please, students, take a note here. In this question, preference dividend is given. Don't get confused. It's just to be treated as profit not available for distribution. So on 100 lakh, 12%, 12 lakhs we can reduce. That makes the distributable profit as 18 lakhs. So this is earnings for equity shares divided by number of shares. How many number of shares we have here? 3 lakhs. So 6 per share comes as earnings. We can easily take this 6 minus D into R is 20% divided by KE is 16% whole divided by 16%. So we have to just solve this equation and find value for D. Dhyanesh has given the response already, which is 120. I think that would be for the previous question. Yes. And Abdullah is saying 12 lakhs. 12 less, I think you were saying about this preference dividend. Okay, then what is the 20%? 6 minus D, yes. So D will be 3.12 per share. If you calculate this, solve the entire this thing, then DP ratio will become dividend payout ratio is 3.12 divided by 6 into 100, which is around 52%. So 52% of your earnings you need to distribute, then your market price per share will become 42. It is not optimum. Students, please note this is not at all an optimum payout ratio, but still, since the question has asked this, we have calculated the same. Okay, students, now let us move to the next theory, next model, Gordon's model. This is part of relevance theory, right? So Gordon says that P0 is equal to E1, 1 minus B divided by KE minus BR. Very simple formula, no complications, nothing. So I'll explain everything. P0 is equal to price at the beginning E1 is equal to earnings at the end B is equal to retention ratio. Here it is ratio because we are using 1 minus B, so 1 minus ratio of retention. KE again cost of equity, which is the expectation from shareholders. R is equal to return on investment. Okay, students. Now, what does this formula say? So this formula says a very simple thing. It says that whatever earnings you do, okay, out of that earnings, you are investing something. So that will give you growth. There is an expectation of shareholder, which is KE, and BR is growth, right? If you carefully read this, this is growth. B into R that we studied above. So the expectation of shareholder minus growth is taken as a denominator, assuming that constantly shareholder will expect KE growth and KE return, and company will deliver BR growth. So that is offsetted by the expectation, correct? Because if let's say growth is 2%, shareholder expectation is 8%. So net 6% is what we have to talk about. So that 6% is taken as denominator, and in the numerator, dividend equivalent amount is taken. Because even 1 minus B is actually dividend that is going to be paid on the year end. Correct? In other words, also, if I just expand this formula, I can take another way to explain this. I'm taking G here. So let's take it up there and let's take P0 down there. KE minus G is equal to E1 1 minus B divided by P0. KE is equal to E1 1 minus B P divided by P0 plus growth. So this gives us the second conclusion. It's not a conclusion, but I just wanted to prove the formula. So what is KE? What is the expectation of shareholder? There are two expectations of shareholder. One, whatever dividend they are getting, correct, vis-a-vis whatever amount that they have invested in the form of P0, that will give us 1% of the return, because they will expect some dividend on the return on the amount that they invested. So the first part is giving us that. This part is giving us that. The second part is giving us the growth element that the shareholder expects. So simply, so this formula has been rearranged to go up to the original formula of Gordon. Simple. It's a no-brainer actually. Okay. So let's come to question number 4. Very easy. I think the formula is very easy. So Walter model and Gordon model. So all of you might think that then why there is a need of having a separate Walter model or Gordon model. See, the delivery is same for both the models. How I can tell you is, because in Gordon model also, the growth form, which is where R is greater than KE, there is zero dividend that needs to be paid. That is the optimum dividend. And the relationship between the market price per share and dividend is always negative for a growth form. The same table that we studied in Walter model, the same table applies to the Gordon model also, because directionally both of them are telling you the same thing. Okay. And we can prove it also, but I'm not going to that extent. Okay. The following figures are collected from the annual report of XYZ Limited. There is again net profit. There is a outstanding preference share, number of equities, this. Calculate the price per share using Gordon's model. If you see exactly the level of details are same in question number 3 and question number 4. In both the questions, we can apply Gordon and Walter model interchangeably. Okay. But he's asking for 3 percentages. So we will calculate that. So first of all, students, R is greater than KE, right? But the question is not asking us to calculate the payout ratio. Instead, question has already given us 3 cases. So as per the Gordon's model, we know that this is the formula. Okay. Now we have been given 3 cases, 25%, 50%, and 100%. These are the 3 cases that are given to us. B, 75%. So if 25% is the dividend payout ratio, the retention ratio is 75%. Here it is 50 and here it is 0%. And similarly, 1 minus B is same that we have already mentioned on the top. Okay, so 1 minus B is this, B is this much. Simple, because either you will retain or you will pay. Now calculation of earnings per share. Net profit is how much? 30 less preference dividend is 12 lakhs. It is 30 lakhs. Correct? So 18 lakhs becomes the available distributable profit divided by the number of shares. It is around 3 lakhs. So 6 per share becomes the earnings per share. Simple. So we will calculate when dividend payout ratio is 25%, then P0 is equal to 6, 1 minus 75%, which is 1 minus B. We have already seen 1 minus B is 71 minus 75%, right? Divided by KE. KE is 16% minus 75% into 20%, BR. Correct? What is B? B is 75 in the first case. So this gives us amount of 150. Second case, when dividend payout ratio is how much? Is 50% in the second case. So P0 is equal to 6, 1 minus 50%, 16% minus 50% into 20%. So this comes as 50. The last is when dividend payment ratio is actually 100%. In this case, P0 is equal to 6, 1 minus 0%, 16% minus 0% into 20%. So this will come as 37.50. So students, please note, since this is a case of growth firm, because RE is greater than KE, sorry, R is greater than KE. So for growth firm, the optimum dividend payout ratio should always be 0. But since we are increasing our payout, you see the share price is following. 150 is going down to 50, 50 is going down to 37.5. So hence proved that, you know, the MPS and dividend have some correlation which is different from the irrelevant theory. Correct? Because in irrelevant theory, we saw that exactly dividend will reduce your MPS. Okay. Thank you, Jaspreet. 6 per share. Yes, Abdullah, you're right. Janesh, 6 per share is perfect. Geet is saying MPS will be highest in third case, I guess. No, Geet. MPS is coming as less in the third case. Okay. Parth, dividend increase, payout per share decrease. Yes. You're right, Parth. Because It's a negative correlation, right? As we studied in that table. So what is next for us? Next for us is bird in hand theory. This is a Gordon's revised model, okay? So again, continuing with the same Gordon's model, I would say that this is third B. Third is Gordon model and third B is some amendment in the Gordon's. It's not amendment actually. It's a evolved version of Gordon, okay? Bird in hand theory. So why is the name of this theory as bird in hand? So bird in hand means, nobody is concerned what are promises made to us. What company makes promises to shareholders that in future we will give you, 10 rupees of dividend. Shareholders will say, whatever you give me now, I will value that more compared to what promise you give me that you will pay me in 1 year. Okay. Even if that payout after 1 year is substantially higher, I will not value that more. I will value what I have in my hand now. That is called as bird in hand theory. If you give me 5 rupees of dividend today, I will prefer that more over a promise of giving 10 rupees dividend 1 year later. Okay, I hope you understood. This is again Gordon's revised model. So what is said in this? Investors prefer today's certainty over future uncertainty. So P0 is equal to D0, 1 plus growth rate divided by KE minus G. It is very much similar, students. There is no change at all. Can I rewrite this as D1 divided by KE minus growth? This is a very compact form of the formula. Simple. So P0 is equal to price as on today. D0 is equal to dividend as on today. D1 dividend after 1 year. KE cost of capital. G is equal to growth rate, which is also called as D into R, right? So D0 1 plus growth. So this I have mentioned as D1, which I can write, correct? Because D0 will grow to the extent of growth rate. Correct? Always remember that my first example of steel. How did that growth came? Growth came because of the reinvestment. If the growth came in profits, the growth will also come in dividend with the same rate. So hence D0 1 plus growth will become D1 after 1 year, right? Manoj Kumar Thakur is telling a proverb. I have not heard it, but I can tell in front of everyone. One bird in hand is better than 2 in the bushes. Okay. Nice. Dhyanesh is saying R is greater than KE. If we pay more dividend, then MPS will decrease. Yes, Dhyanesh, that's what we discussed. You're right. Okay. Good one. So P0, D0. So this is all explained. Is there any issue with this formula? No, right? It's a way. I mean, ultimately, what I feel he has, made his formula more easy compared to the previous one about Gordon. Okay, so just remember this. Let's move on to the other theories. We will do a lot of questions again on irrelevance theory, Walter model, Gordon model, M&M approach, everything we will do. So we have today's session as well as next session to cover some, additional questions, some of the additional practice questions. We will cover some additional practice questions even for risk analysis and capital budgeting also that we covered in the previous session. Okay. So let's go to the fourth one, dividend discount model. What it says, the price is actually you take all the dividend that is expected to be paid. And just like you do a present value in your capital budgeting decisions, you do a the present value like the same way. So whatever dividend is expected to be paid in after 1 year, take a present value. After 2 years, take a present value. After 3 years, take a present value. So present value is raised to the power 3 year, right? Because it is after 3 years. Similarly, at the nth year, take the present value at the nth year. Okay. Simple. Dividend discount model is very simple. It says that you take your future dividends and discount them. Simple. Okay, students. Now, can I relate all of the things that we have studied till now? I will mention, let's say, 3 scenarios. One is zero growth. Second is constant growth. Third is variable growth. So students, there is one more point that I want to tell you. See, in all our previous cases, we always assumed one inherent assumption again, which is growth is constant. Growth is equal to BR. I think one of the student also raised this question that growth is just like a compounding. Okay, I don't want to touch this point at that point of time. Hence, I told yes. But actually, if you ask me, till now, we have studied that growth is constant. Growth is not like compounding because it is always B into R. So it is fixed. But in reality, practically, we don't have constant growths. Growth also keeps on changing every second, right? So what happens? Hence, we say that there are 3 cases. One is constant growth, one is variable growth, and one is zero growth. Okay. So just to study theoretically, zero growth, how will you calculate the price? Simple. A more compressed version of Gordon, wherein we have removed growth, correct? Because there is zero growth. Even if you will take growth, it will be zero only. So the formula is compressed to price is equal to dividend divided by cost of equity. If there is a constant growth, you just apply Gordon's revised formula, which we have studied. So which was P0 is equal to D0 1 plus growth divided by KE minus G, or P0 is equal to D1 divided by KE minus G. This is the constant growth formula, right? These 2 formulas we studied. In case there is a variable growth, then you please go to dividend discount model, wherein you will take the future stream of cash flows of dividend and discount it with the cost of equity. So in this case, you can assume discrete growth, right? So for example, D1 to D2, there is a growth of 10%. D2 to D3, there is a growth of 6%, like that, correct? So whatever that comes out as a cash flow, you take that cash flow of dividend and take the present value of it. We will cover questions on all the cases. We will cover questions. Danish, yes. Both the theories of Gordon will give you the same example, will give the same answer. Even Walter and Gordon also will give you the same example, okay? Mohammed is saying, yes, sir, clear, okay, perfect. Jaspreet, in this, we are discounting the dividend is 1 plus cost of equity, sir. Yes, we are doing that. You are very much right, Jaspreet. Okay. Here we are not concerned with the earnings, because what we say that whatever you earn in year one will be reflected in the dividend of D2. Similarly, whatever you earn in year two will be reflected in dividend of D3, because it will be higher. Ultimately, it will be higher, right? Okay. Zero growth is no growth. Yes. So Mohammed is asking, can zero growth be called as no growth? Yes. Zero growth is no growth. So let's see what is next now. We'll go to question number 5. First, it's a no growth company. Pays a dividend of 5 per share. Till eternity, it will keep on paying 5, 5, 5, 5, 5. Cost of capital is 10%. Can you tell me the price? 5 by 10%, 50 rupees. Very basic question. Alok is asking, we have to do it for more than one time in variable growth rate. Yes, Alok, more than one time in variable growth rate, because it will keep on changing. Perfect. So fifth is done. Let's go to next question, which is sixth one. Sixth question is XYZ is a company having share capital of 10 lakhs of rupees 10 each. If the current dividend if the distributed current dividend of 20% per annum. So they are saying ki it has a share capital of 10 lakhs, 10 rupees per share, and currently it distributed 20% dividend per annum. Annual growth rate in dividend is expected to be 2%. The expected rate of return on equity is 15%. Calculate the price applying the Gordon's growth model, okay, which is the revised Gordon's model. We can just quickly write. Perfect. Why I'm using D0? Because the question has given us D0 equivalent value. If the question has given us D1, we will take the D1 value, right? So P0 is equal to D0 is 10 into 20%, correct? That is D0. 1 plus growth rate is what? Growth rate is expected at 2% divided by KE is 15% minus 2%. So this comes as P0 is equal to 2 into 1 plus 2% divided by 13%. So the price becomes 15.69. Very nice. I think the previous one, all of you gave your answers. Alok, Ganesh, Abdullah, Mohammed, you are saying it is zero growth, perfect. Jaspreet, question 5 is 50, yes, all of you are right. Alok, Abdullah, 15.69, yes, you're right for this question as well. Very nice. Glad to see all of you. Let's come to question number 7. A firm had paid a dividend of rupees 2 per share last year, which is fine. That means it is D0. The estimated growth of the dividends from the company is estimated to be 5% per annum. Growth is 5%. Determine the estimated market price of the equity share if the estimated growth rates of the dividend rises to 8% or it falls to 3%. So we have three scenarios: 5%, 8%, 3%. Growth, growth, growth. So in all these three scenarios, we have to find out the present market price of the share, given that the required rate of return on investors is 15%. So we are here already given D0 is equal to 2. Growth, we have given different. KE is equal to 15%. So current MPS at the rate 5% growth can be again calculated using Gordon's revised model, right? So P0 is equal to D0 1 plus growth divided by KE minus growth. This is the Gordon's model formula. D0 is how much? 2. 1 plus 5% divided by 15 minus 5%, which is essentially 21. So P0 is equal to 21 for first case. The second case, growth at 8%. Okay. So applying the same formula, 1 plus 8% divided by 15% minus 8%. So it gives 30.86. Third formula, third case, growth is equal to 3%. So it gives 2, 1 plus 3% divided by 15% minus 3%, which is 17.17. So students, I hope the concept is clear now. I'm just okay. I'll take the queries one by one. First, let me just explain this important concept here. I've tried to compare the different market prices at different growths, keeping rest other things same, right? If the growth is, let's say, 5%, the market is valuing that company's share price as 21. If the growth rate is at 8%, the company is valuing at 30.86. If it is slipped down to 3%, even if it is lesser than 5%, the share price will also come down from 21 to 17.7. So this makes sense, right? To all of you, this makes sense because higher growths will lead eventually higher prices, higher market prices. Correct? That is what we are trying to understand. Sharon is asking, I'm not able to analyze what is the D0 in last problem. Okay. So D0 is always the current year dividend. See, if you see in question number 6, it clearly mentioned it distributed current dividend of 20% per annum. Simple. Correct. And in this question also, it said that the firm had paid per share last year. So you can easily assume it is D0. Okay. Prachi is asking, sir, in fifth question, 10 into 20%, why? Fifth question to this one. I think Prachi, you are asking for this one, if I'm not wrong. In the previous one we did, no? Yeah, this one. Okay. Let me do one thing. Here D0 is equal to 20% on 10 rupees. What is the face value of share? 10 rupees. 20% is the dividend. Percentage wise, whenever we talk about it, is always on the face value. So D2 becomes 2. That is what I have directly put here. Okay. Abdullah is saying 14. I think for the previous question, you would be saying 14, but it's not there. Please check, Abdullah. What is 14? 30.86, 17.7, 14.4. Yes, Abdullah. 21. Yes, that is right. 30.86, 30. Abdullah Dhanesh. Abdullah Dhanesh. Mohammed. Yes, you're right. 21, 30.87. Perfect. Sapna. Yes, sir. Thank you, Sapna. Part growth increases, price also increase. Yes, Parth. Very good. That is what we just now concluded. Growth increases, price also increases. Growth rate, direct relationship with MPS. Perfect, Alok. Mohammed is saying when to solve exam questions, March or April? No, I'm not clear. Mohammed, can you please elaborate your query? Which exam questions you're asking? Sharon, then what about 10 lakh? With 10 lakh? No, 10 lakh. Okay. See, 10 lakh is the total share capital, right? We are calculating price per share. Hence, we have taken face value also per share. 10 lakh you can ignore simply. Okay, Sharon. Okay, so let's go next. Okay. So the next one. Now, please don't ask me any logic for this next theory. Okay. The next theory is traditional. There are two traditional theories that we have to study apart from irrelevant theory, relevant theory, revised Gordon's model, Bird and Ant theory, all those things. There are two traditional theories that we have to study, but just remember them. That's all. Graham and Dodd model, which says that P is equal to M D plus E by 3. This is something specific that they have given, right? Maybe some logic that they might have, but for us, basically, I can only tell you that P is equal to price per share. So M is some kind of a multiplier. So what they say is that there is just like, there is a P multiple, right? So that multiple is multiplied in earnings to arrive at price. Similarly, this multiple is multiplied into dividend and earnings in some ratio to arrive at price. Okay. D is equal to dividend and E is equal to earnings. Now, students, what Graham and Dodd are trying to say here is that the shareholders will place only 1/3 of weight on earnings to dividend. So dividend is having more weightage to the shareholders as compared to overall earnings because they are again burden and theory. Whatever they have in hand, they are actually happy with that. Okay. So we'll quickly see this question. Question number 8. Okay, so Mohammed is asking previous question papers. Mohammed, you can solve it anytime. Okay, you can solve anytime. You can even solve it now for the topics that you're covering. So you can select and solve them. That's fine. But dedicatedly, I mean, the most focus should be on previous attempts or let's say the study material, RTPs suggested, and if certain other subjects have some sort of amendments, do cover them. So try to be as close as what lot of literature that institute has published, and you can do it anytime. There is no this thing required. Answer 2, honey, you are asking about answer 2, is it? You are talking about question number 2. Okay, let me display that. Meanwhile, I am taking some other queries. This was first, then this was second. Janish, how to calculate M? M is given. M is just like a multiplier, Janish. So Jaspreet and Abdullah have calculated the answer also. For the next question, let me calculate and tell you. So honey, you can just note it down. This is the answer to, okay? Very easy. It was just a simple application of Walter's model, okay? Question number 8. We were in this, yes. So the earnings per share of the company is 30. E is 30. D is 60% of 30, which is around 18 rupees. M is equal to 2. Price will be 2 multiplied by 18 plus 30 by 3. So 30 by 3, 28 into 2 is 56. Yes, you're right. Price is 56. You see, very easy. So Jaspreet and Abdullah, you're right. Okay. Let's go to question number 9. This is a tricky one. This is a tricky one. So, I mean, not a tricky one, but yes, something different. So, the following information related to equity share is given below: market price, dividend, multiplier. According to Graham and Dodd model, compute the EPS. Simple. So, we know that price is equal to M D plus E divided by 3. This is what the price is. Price is given as 58.33, M is given as 7, D is given as 5, plus E we have to calculate. So we can calculate E as 10 rupees. Okay, students. So Dhyanesh is asking why divide by 3. I'm saying that, it might have been, they would have concluded, the ones who have made this model, that, earnings have only 1/3 weightage to what dividend have for the price. Correct. So that is why they have taken 3. There is no other logic. Price per share 28. No, Mohammed. Price per share is 56 because you have to multiply it with the multiplier also. The previous question, Mohammed. Parth, you're right. Price was 56. Now we will cover, I think, the last model in traditional, which is Lintner's model. This is also formula-based model. Okay. So it says that D1, the dividend amount, is always a result of two things. One is the steady state dividend that we are paying, which is as good as D0, correct? Because D0 is the last dividend that we have paid, or let's say the exactly dividend as on today. So that is bare minimum, plus earnings per share multiplied by target payout. Minus D0 multiplied by adjustment factor. This is the formula. D1 dividend in year 1, D0 dividend in year 0, EPS earnings per share, AF adjustment factor. Yes, Dhanesh and Parth, EPS was 10 in the previous question. So students, please note, this is, again, a very formula-based thing. However, there are some logics for Lintner's model again. So what they say is that bare minimum D0 is there, that we've already discussed. Then they say that there is a that there is a target payout ratio. So it is one of the dividend theory that says that, the company always have a target payout ratio. One of the theory says that. And whatever is the target payout ratio, that will definitely be multiplied by EPS. That will give us the target payment of dividend, correct? From that, you reduce whatever you have already considered, correct? So that will give you the incremental amount. However, there is a constant adjustment happening. Adjustment factor is because, today we feel that, okay, it should be okay, but tomorrow it should be higher or lesser. That is governed by the adjustment factor. Again, it's just kind of a multiplier that we have seen, correct? So this is just to moderate the amount that comes. And this also would be given. So let's go to question number 10. Given the last year's dividend is 9.8, speed of adjustment is 45%. So adjustment factor is 45%. Target payout ratio is 60%. EPS is 20. Compute using Lintner's model. Current year's dividend they are asking, correct? Because Lintner will give us the dividend. As you can see, the formula gives D1, right? So last year dividend was 9.8 plus 20 is EPS, target payout ratio is 60% minus 9.8 is D0 whole multiplied by 45%, which is the adjustment speed factor. So D1 becomes 10.79. Perfect, Alok. Your answer is right. Okay, students. Now, students, let's go on to the next, the last basically concept. It's not a theory, it's just a normal concept. What is a PE ratio? PE ratio, I think most of you would know, it's MPS divided by EPS, correct? Market price divided by the earnings per share. It can be, let's say, 17 times, 20 times. Higher PE ratio means higher trading, or let's say higher value is perceived by the shareholder on 1 rupee that you earn. Correct? So 20 times PE ratio means that if you earn 1 rupee, shareholder would be willing to give 20 rupees for that share. What is KE? KE is just reverse of PE, right? KE is the earnings that the company do divided by the market price per share. Can we also say that there is a inverse relationship? So KE is equal to 1 by PE ratio. Or can we also say that PE ratio is equal to 1 by KE, whichever way you want to say. The message is same, right? Correct? And then what is R? R is actually earnings per share divided by book value per share. So this is the difference between R and KE, because KE we are dividing by market price, correct? R we are dividing by book value per share. Yes, Alok. Jaspreet, you are right. 10.79. Yes, not 19.7, 10.79. No worries. So we will do last question of today. Then we will wrap it up for today and we will continue with the same thing and some of the quick revision and some additional questions in the next session. So let's take it up. Question number 11. Please read it very carefully. Earnings of the company 5 lakh. The following information pertains to Messrs. XY Limited. They're saying the earnings of the company is 5 lakh. Dividend payout ratio is 60%. Number of shares outstanding is 1 lakh. Equity capitalization rate KE is 12 and R is 15. Calculate market value as per Walter's model. So this is a good question to revise. Walter's model, what was the formula? D, E minus D, R divided by KE, whole divided by KE. This was the formula, right? For Walter's model. So if we say D is what? D, we know that it's 5 lakhs is the earnings and 60% is the dividend payout ratio. So 5 6 are 30. And this whole divided by number of shares are how much? 1 lakh. So 3 per share is the dividend. Earnings is actually 5 lakh divided by 1 lakh. 5 per share is earnings, correct? So we can just simply put it in the formula. P0 is equal to 3 plus 5 minus 2 multiplied by R is 15% divided by 12%, whole divided by 12%. Simple. So this will give us P0 is equal to 45.83 per share. So this is the first part of the question. No, Alok, please check. 37.5 is not the right answer, at least for the first part. I'm not going to the second part. Manoj is asking which one is the most practicable theory. All theories are most practicable, okay? Because this will help you to score good marks. That is the practicability of these theories, okay? And see, ultimately, students, see, keep one thing in your mind that, the idea or the objective here is to get the thought process activated in all of you, right? That, there are different ways of doing things, correct? And all of them could be right at the same point of time. As a professional, we have to learn that, correct? Janesh and Alok, yes, you're right. Let's go to the second part. Optimum dividend payout ratio according to the Walters model and the market value of the company share at that payout ratio. So the optimum dividend, since R is greater than KE, optimum dividend payout ratio is 0. Correct? So the second part is, since R is greater than KE, optimum dividend payout ratio would be 0, and it would be recommended, and it is recommended to reinvest the funds back in the company. And it is also asking us to calculate the price. If it is 0, then similarly, P0 is equal to 5 minus 0 into, I forgot, 15 and 12%. So P0 is 52.08. So the price has increased, right? Because the dividend, we are following now the optimum dividend policy, which is 0. And hence the price increased from the previous situation of 45.83. Now it is increased to 52.08. Yes, Alok, you are right. For second part, it is 52.08. Perfect. Geet is saying thank you for the session. Thank you everyone for attending this. Janesh is saying 52.08. Perfect. So thank you everyone for joining today. Okay, wait, there are 2 more queries. So Parth is saying return on investment is more than cost of capital, dividend decrease, price per share. Yes, you're right, Parth. Again, the same logic holds true that if R is greater than KE, lesser you pay dividend, higher is your MPS. Alok is asking, sir, generally saying we are solving questions. Sorry. Generally saying we are solving questions here, but how to remember formulas for long time. Alok, see, the idea with which I am also, taking, or let's say, making all of you learn is, I am also trying to give you some or the other logic or trying to create some story behind the formula, right? So one is that definitely, you will have to do a lot of revision. I mean, at least 2 to 3 times the entire curriculum should be revised. That is one way to remember. Second is definitely the logics part of it. Correct. So directionally, we should understand what it is saying, right? Hello? But it will happen. I mean, don't get too stressed. It will eventually happen if you put right amount of effort in terms of revising. Because understanding is one thing and revising and retaining is the second thing, right? Mohammed, you're right. Completing 3 chapters each day in order to solve previous papers, even sacrifice sleep. Yes, you can do that, Mohammed. Jyoti, perfect. Your answer is right. Prachi, thank you. Pranav, sir, even if we mug up the formula, is it enough? Because logic ka to pata nahi. No, don't. See, mug up should be the last option, Pranav. So, for example, now, mug up will not eventually help you in the long run, correct? It will only help you in the short run. So according to me, mug up is the last and the very last resort. Don't mug up. Try to follow the logics. Try to build logics in your own way for the formulas, right? Then it would be easy for you to retain it. Honey, you are right. 52.08 is the answer. Parth. Thank you. Thank you, Parth. Jaspreet, you are right. Mohammed, done. Mohammed, I answered. Thank you. Alok, thank you. Danish, thank you. Yes, Danish. Danish has also given a good recommendation. If we solve more questions, then we can remember formulas. And the best part is, while I also try to, solve this, I always try to write maximum times the formula. Now, Walter model we studied some 1.5 hours back. Hence, I thought of writing the formula again, right? So that it again comes in the revision and, we are able to remember it. Okay. Chalo, all the best students. We'll catch up in the next session. We'll cover the balance part and we will cover the balance, some other good questions. I have 4 very good questions for all of you, which are very practical. So we will cover them. Okay. Thank you. Technical team session over.